So in this slide, I'm going to talk about how to really stay consistent. This is going to take a big effect into your future trading performance. And this is, I would say, more important than the patterns. And as long as you keep staying in those rules, then you should be good to go into your trading in the future. So first one I want to go over is don't trade anything that you don't know, especially that ETFs, biotech stocks, energy stocks. These tickers, they don't have a really stable statistics, especially the ETFs. They do not follow any edge, resistance and support, they do not work. So these, I would say, sectors you have to stay away from, and other stuff as well. Before you trade anything else, always test the patterns first. And before you find the edge, there's going to be, I would say, thousands of tryouts before you actually start making money. First of all, track your own statistics. Boost your confidence first before you get into any sectors that you don't know. Also, there is regular emotion that's called FOMO, and a lot of people tend to get really FOMO if they see anybody that are on Twitter making money or on social media making profits left and right. And then that, I would say, image give you tons of FOMO. The same thing gives to me. Once I found my edges and patterns, I stopped looking at social media because trading is all about yourself and self-improvement, and also setting up hard criteria for yourself. So if you feel FOMO, and I would suggest write your criteria down on a white paper. Then before you short or buy any pattern, buy stocks to see if they fit any patterns that fits the hard criteria that you wrote down. And that should control your FOMO. And if it doesn't fit the criteria, just don't trade. So in this way, at least it will keep you from making random trades. And random trades is, I would say, the most harmful trades that you can make especially if you're a beginner trader, because these random trades losses, they add up, and they can add up to a big chunk within a year. So keep paying attention to that. And also, you have to consistently tracking. Doesn't really matter if you found your edge or not. Market is always constantly changing. So adjusting your criteria and constantly adapting the market and tuning your strategy is the major thing that you want to be able to do while you are updating your strategies. Trading is only about you, not about other people. And as I said, that at the beginning, that you're looking for a mentor, you're looking for other people that in the same sector, and you want to see how they're performing, and you want to see what else you can learn. So to be able to distinguish between other people's trading and other people's gain on the social media it's okay to take a look at their trades to see how much money they made, and you want to know where their entry and exit is. So you want to track that down to see if that performance is repeatable. If it's only one-time thing after you tracked for 150 times, then those trades are not something you want to copy. Always, I would say, take stuff from others and always keep a doubt on their patterns, because you want to see on yourself and track your own statistics to see if you can actually make that profitable and be consistent with it. So also you need an unbreakable risk management, because trading is all about managing your risk other than patterns. It's because first you need the edge, second you need to manage your risk. For example, let's say you made 10 trades in a row that are all green and you're really happy, and your ego is starting getting out of control, and all of a sudden you make a trade that doesn't fit your criteria and you made a mistake. This is where risk management can come in and protect you, is because if you set a max loss on a trade, then you should help you to cut your losses quickly, and once you reach your max loss, then you just move on to the next trade and you can make it back pretty quickly. But if you let that trade keep running against you longer and longer and it breaks your max risk management, then that's where you start losing all of your gains from the last 10 trades. And all of a sudden you feel your confidence will get dramatically beat down. That's where you're not going to make confident trades in the future. And it will take a while to recover that confidence. That's where it's going to be a difficult time for traders to endure. And having that risk management is very crucial. So another thing is the longer you survive, the better you will get. A lot of people don't understand that because they see the pattern as a one-time event and they want to get in and they want to make that profits quickly. And sometimes they only see this one trade and don't see the longer picture. All of a sudden they get married into one tickers and they can't stop trading it. They start over trading it 10, 15 times in one day. That's where you start, let your emotion get out of control. That's where the max loss comes in your account statement. So understand that you always want to survive in this market, and sometimes taking a max loss, it's okay. Try to not get, I would say, be too down with it, because you're going to take losses while you go on into the future for your trading for performance. So losses, you can learn from them. And also, as long as you don't make one of the mistakes that just blew up your entire account and you did not follow your risk management, that's where things can get really ugly. So losses is going to be there all the time, as long as you learn from your losses, and the longer you survive on the market, the more experience you will gain. That's where you can get a lot better in the future. So that's something most people don't get, and that's why I want to track the frequency of the pattern to see how many times they happen per year, so you can see the bigger picture. You don't have to focus on specifically one ticker in that one day. One more thing I want to cover is don't predict, only react. A lot of people tend to make predictions in different charts, and they see a ticker that went from 3 to 5 and they want to predict, oh, I'm going to predict this stock is going to reach $10, going to reach $15. Personally, for me, I've been trading for 8 years for now. I still couldn't predict exactly where the stock is likely to go. And sometimes I do have a feeling that where the stock is going to stop. Let's say gap up short or bounce short, typically they bounce 20 to 25% after open, but there's that 5% gap. I don't really know where exactly it's going to stop. So a lot of people tend to predict, okay, I'm thinking this stock is likely to go to 8.5, 10.5, 10.2. Those things are nonsense. Do not try to predict the stock where it's likely to go, only react. If the stock goes into a range, that's where you want to use your level 2 skills, use your statistics to be able to top take a ticker, and do not try to predict exactly where it's likely to go. And that's something I don't want to focus on, because in trading, because you don't know where you want to short at, and you have to take multiple entries on your shorts, that's where you can get your average much better. If you only have that one price point, let's say 10.2, you're not going to trade anything other than reach 10.2. That's not ideal. That is not trading, because nobody knows where it's likely to go. So you react based on the average statistics, and once you see a level 2 stuffing, let's say the candle equals 10% of the float, then that's where the stock is likely to top. You will also want to short into strength. So that's something you have to take practice into. I'll be going over those concepts in the later slides, and moving on to the next one.